morning to everybody. Thank you so much for taking the time to join us, and a very, very warm welcome to Lizanne Botha and Eugene Dutoy from the FSCA, who will be joining us and providing us with the presentation today. We're very grateful to have them with us. So without further ado, it is already 3 minutes past 10. Good morning to members and welcome to today's presentation on CoFI readiness. We believe this is a really important session as we navigate the significant regulatory transformation in South Africa's financial services landscape. Understanding the CoFI bill and its implementation trajectory is critical for all intermediaries. And today's session should bring together some key architects of this legislative reform, and we're privileged to have insights directly from the FSCA. The presentation will take us through the purpose and key elements of the bill, provide crucial detail on how the FSCA is preparing for implementation, and outline the transition pathways to the new subordinate legislative framework. Whether you're a Category 1 FSP, a Category 2 FSP, a rep, or an industry administrator, the implications of the reform spanning licensing, governance, operations, and conduct requirements will impact your business. We really encourage you to listen carefully, engage with the material, and actively participate in the consultations that will follow. Then just a brief bio on our speakers today. Eugene Dutoy brings 19 years of financial sector experience spanning legal, compliance, and regulatory policy roles in both private and public sector contexts. As departmental head of regulatory frameworks at the FSCA, Eugene is responsible for developing and maintaining all legislation under the FSCA's jurisdiction. He's a recognized expert in financial sector regulatory policy and has been instrumental in the major legislative reforms that have reshaped South Africa's financial services landscape, including the transformation to the Twin Peaks architecture and the shift towards outcomes and principles-based regulation. Eugene holds a BCom in law and an LLB, supplemented by postgraduate qualifications. Lizanne Botha is a senior manager in the regulatory policy division of the FSCA with 15 years of financial services sector experience. She's an admitted attorney with right of appearance in the High Court of South Africa, and her career has spanned private law practice and in various roles in the financial institutions and the South African Insurance Association. At the FSCA, Lizanne oversees critical areas including insurance, microinsurance, financial markets, benchmarks, and retirement funds. She holds qualifications including a BA Honours in Psychology, cum laude, an LLB, and a Master's in Insurance Law, all from the University of South Africa, along with a certificate in legislative drafting and a postgraduate diploma in management practice, both with distinction. Internationally, Lizanne serves as chairperson of the International Association of Insurance Supervisors Governance Framework Group and leads the FSCA's Joint Governance Regulatory Framework Work Group. She brings a particular expertise in behavioral economics and its application to effective regulation and policy development. We're very, very grateful to have Lizanne and Eugene presenting for us today, and are really looking forward to an informative session. Over to you.
Thanks so much, Sam, and welcome everyone. It's really a pleasure having this engagement with you. You know, as we have been speaking about the CoFI bill for many years now, I think, and it seems to just not get to the point that we want it to be. So everyone is so eager to understand what is coming. And I think at last we are actually at a point where we are seeing a bill that will be going into the parliamentary system soon. So it's really, I think, a very appropriate time to start talking a bit more detail about what you can expect, what the FSCA is doing in preparing for the CoFI bill, and what you need to consider in preparation. So we have a relatively short slideshow. Lizanne, will you be flighting that on your side? We're going to talk through it, but I think let's try and keep it interactive, Sam. So anytime you want to come in and discuss any points, you're welcome to do so. And we titled this CoFI Bill Readiness because it's to a large extent looking at what we are doing in preparing for the CoFI Bill. We do have some concluding remarks that is more industry facing, but it's really to give you a sense of how we are preparing, what you can expect, and that will give you hopefully some information to start your implementation process, or at least start thinking about implementation. So we just shortly, the agenda. I'm just going to reposition the purpose of the bill, seeing that it has been a while since the initial version was launched. We will give you a high-level overview of what the bill covers, noting that the most recent version is not yet publicly available. We do delve into some of the content, but just note that it is subject to change. So that's my disclosure, I would think, is that this is based on the recent version that we have seen. Then we will talk about the FSCA, CoFI Bill Readiness, what we are doing. We will unpack that a bit in terms of what it means for the subordinate legislative framework. And then, as I said, some concluding remarks, which is really aimed at you. All right, Lizanne, thanks. We can move on to the first discussion. So by now, I hope everybody is fully aware of what Twin Peaks tried to do. So that, I mean, that was initially published in Treasury's Red Book in 2011. And it was essentially to split conduct and prudential regulation, and in doing so, also placing a bigger emphasis on conduct regulation. So to give it a very specific focus through a dedicated conduct regulator. What was a big import to call it the conduct puzzle is the legislative framework, because in 2014, Treasury published its paper titled Draft Market Policy Conduct Framework for South Africa, which sets out its views of what the conduct framework would look like. And some of the risks that they highlighted is that because there are various sectoral laws dealing with conduct, so you've got your FASE Act, CISCA, the Pension Funds Act, which deals with elements of conduct, and various other acts. The issue is that those acts, although all of them regulate conduct, those acts also deal with similar sort of themes. But the problem is that it creates fragmentation because they deal with the same type of themes, but they deal with it in a different way. And that's brought about by the fact that we have these multiple laws governing conduct. What it also does, it results in fragmentation, but it results in inconsistent outcomes for customers because the baseline requirements are different in the respective laws. So one of the main intentions with the bill was to streamline the conduct landscape by providing this single comprehensive market conduct law. Also important is that they emphasize that a shift to a more principles and outcomes-based approach is necessary because there are various problems with the rules-based approach, and I won't elaborate on that in much detail now. But an outcomes-based approach is necessary, one, because you now have one framework covering a very broad scope of institutions, from your small financial advisor to your big bank. And you can't have a rules-based approach because if you embed, for example, robust governance requirements, it might not make sense in the context of a small advisor. So there needs to be more flexibility, and how you create that flexibility is through this outcomes and principles-based approach. Then another objective was to support the FSCA with more effective tools and to cover critical areas such as transformation, financial inclusion, competition, innovation. So really key themes that wasn't previously addressed through all of these frameworks. And then lastly, the issue was that although the then FSB, and shortly after that, the FSCA regulated the conduct of the financial sector, many activities which are viewed as forming part of the broader financial sector was not included in this framework. So again, inconsistency if you look at the framework holistically. So the last objective is essentially to broaden the scope of the FSCA's jurisdiction and to bring in all activities that one would view as forming part of the broader financial sector. So the ultimate outcome here is strengthen customer protection, resulting in consistent application of consumer protection principles across the whole financial sector. Okay, so bear that principles in mind when we start talking about our approach and legislation. Then moving on to the bill itself. So I'm going to touch on the licensing aspects. Lizanne will then run us through the content of the bill at a relatively high level. So in terms of licensing, one key difference here is that it will introduce an activity-based approach to licensing. So the CoFI will bring in consequential amendments to the Financial Sector Regulation Act, and there will be a licensing schedule in the Financial Sector Regulation Act setting out a whole scope of activities. So part one, for example, part one of the activity schedule will deal with the provision of financial products. So that's providing insurance products as an insurer, banking products as a bank, provision of collective investment schemes, etc. So everywhere where there's a product supplier involved. Part two of the schedule then moves over to providing financial services. And it's in this part that there's really a very broad scope of activities. It also perpetuates existing activities, but in a different way. So by way of example, the current definition of advice as captured in the FASE Act is a specific licensing activity, but it's been broadened. So that activity now, for example, covers advice provided in relation to credit, advice provided in relation to Forex, etc. So it's a broadened scope. Secondly, intermediary services in the current phase environment is basically one broad activity. Intermediary services for purposes of the new schedule has been broken down into various sub-activities or main activities. So what you would see in this part two now would be, for example, a sales and execution activity, and that's one part of the current intermediary services. It will have an administration activity, which is also one part. The sales and execution then again is, the distribution, the main activity is distribution, and under that is sales and execution. Sorry, just to clarify. Then another sub-activity would be product aggregation, for example. So all of the activities that is currently under intermediary services is reflected in the schedule, but in a different way. And you will then, when we get to the licensing discussion, the transitional arrangements, which of these activities are you actually rendering, considering that you now have broad approval for intermediary services, but you might not be doing the full scope of intermediary services. So there's already a sort of immediate licensing impact on all FSPs. And then this part also includes a variety of new activities. So for example, investment banking is being brought in, treasury outsourcing activities are being brought in, services related to credit is being brought in, etc. So a very broad scope of new activities coming into our world. And then part three is really your financial markets activity. So that's looking at your authorized dealers or stockbrokers, as you would know it perhaps better, the financial market participants, etc. All right, so I've mentioned a few of the new licensing activities. Other ones that I can perhaps mention is alternative investment funds, which have been brought in. So currently, you might know that the only sort of pooled investments covered through regulation is collective investment schemes and hedge funds. Going into CoFI, it will bring in other forms of pooled investments like private equity, venture capital, etc. Foreign currency, I already mentioned. Credit, I mentioned, but just to note, it includes credit as defined in the NCR, but also credit falling outside of the NCR. So the scope is actually broader than purely the National Credit Act scope. Investment banking, I mentioned. The other new activities, benchmark provision, and then custodian services, etc., etc. All right, just maybe not as relevant to you, considering the nature of your business, but just to mention perhaps a lot of these activities is specifically under Part 1 provision of financial products. These institutions will be most of them in any case, will be subject to dual licensing. So they will have a license from the FSCA and they will have a license from the Prudential Authority or maybe another regulator. And by way of example, banks who are licensed by the Prudential Authority will also now be licensed by us. Same with insurers. Credit providers will be licensed by us now. They're also licensed by the NCR. So there's a very broad scope of institutions that will now be subject to dual regulation. And that makes it very critical to have sort of cooperation agreements with these other regulators. And we are busy looking at that. Sam, did you want to come in?
Please, if I may, Eugene,
Sure.
particularly as you're chatting about this, a lot of our members are regulated by both the FSCA and the Council for Medical Schemes. And we know historically that's posed a number of challenges because of differing standards across the two regulators. So how do you envisage the cooperation and licensing concurrence process will work between the FSCA and the CMS going forward?
Okay, to be honest, I don't think there will be a significant change because the status quo as it stands today is that there is already the dual responsibility. We already have a memorandum of understanding with the CMS and we have agreed on procedures and how to approach this. So I don't think the CoFI bill will necessarily impact it. We might want to, at some stage, I don't know if that would be the top priority at this stage, but if you are saying that there are problems, we might want to revisit whether the current processes are working, what we can improve, etc. But the reality is, just to be frank, is that we've got an existing agreement with them. We don't have existing agreement with many of these other new regulators coming in. So that will obviously be the priority to first establish that. Yes, but I would suggest that if there are specific problems with the current approach, that be communicated to us and we can consider that at a later stage once we review our MOUs.
Thanks, much appreciated.
Okay. All right, that is on licensing. What I didn't do is I didn't go into detail, obviously, on the licensing schedule, but I would suggest that once this bill is submitted to Parliament, this should perhaps be the starting point for most of you is to go have a look at the activity schedule so that you understand the impact, so that you can start understanding which activities are actually relevant to you. And when I get to the licensing transitional discussion, I will unpack that in a bit more detail. Right, Lizanne, we can move on. I think this is Lizanne's turn, so I will have my coffee now. Thanks, Lizanne.
Enjoy your coffee with 500 plus people. Good morning, everyone. This is an incredible privilege, and I'm very encouraged to see so many people who are at this time of year interested in this. It really just reiterates the impact of it. So as Eugene explained, the CoFI bill is bringing in all of these changes, but besides for the licensing, which I also think is probably one of the biggest impacts, there's a couple of other really important impacts that we would want the industry to start thinking about, to start applying their minds on. So firstly, you mentioned the move to outcomes and principle-based. I think to a certain extent we have, through the subordinate legislation, already started doing that. But what the CoFI bill is doing, it's really introducing these high-level outcome-based, outcome-focused principles, which is definitely a shift in how legislation has been developed in the financial sector to date. What it also does is it facilitates proportional application. And I think that's incredibly important, specifically to considering the FIA's membership, and that you really have members that vary from sole props to very, very big multinationals. It's very important to understand that this, because it has such a wide application, it does also facilitate proportional application. And then it also brings in mechanisms to support transformation, financial inclusion, and innovation. I know Eugene did mention that, but I think you will, once you start, when you get the bill and you start looking at it, you'll see how that kind of flows through as key themes in the bill. Eugene did touch on the new type of activities that are being brought in through the licensing. Maybe a few to mention specifically is the research services and the regulation of research services, which was not necessarily there previously. Also, prop trading performed by financial institutions will now be formed part of the regulation, and then also bringing in the retirement fund space, commercial sponsors of retirement funds, not entities that are going to be licensed as such. So it's not a licensing activity, but is being brought in as part of the regulation. I think another important part, and I mean, this has been part of the previous iterations of the bill as well, is the repeal of the existing financial sector laws. So FAIS, as you know it, and as applies, will no longer be a loose standing act. The Long-Term, Short-Term Insurance Act, the Collective Investment Schemes Act, Credit Ratings Agency, Friendly Societies Act, all of those are being repealed and being rolled up into the CoFI bill, and the rest of it's going to consist of standards, and we're going to get to the subordinate legislation a little bit later in the chat. But I think also important to note that some of these requirements are being moved over, so it's not all just disappearing into the nothingness. It's being moved over into the CoFI bill, and then where appropriate, where it needs to be in primary law, it'll be in the CoFI bill or in the FSR Act, as it may be. And then the subordinate legislation, the requirements and the more detailed requirements are going to be set out in the conduct standards. It also amends a number of the existing financial sector laws, as Eugene mentioned. The FSR Act is being changed. The Pension Funds Act, there's quite significant changes that are being introduced through the consequential amendments to the Pension Funds Act, National Payment Systems Act, the Financial Markets Act, and then there's a number of the CMS. You guys had a discussion about our engagement with the CMS as well. And I think then lastly to mention, which is very relevant to this audience again, is that the bill distinguishes between financial customers and retail financial customers and small enterprise financial customers. That was not a distinction that was in the previous iteration of the bill. And I think that is quite an important split of how these different types of financial customers are being captured. So there's the umbrella term is a financial customer. There's already an existing definition for a financial customer in the FSR Act, and that's just being slightly amended. But then it also distinguishes between the retail guys and the small enterprise financial customers. Brad, please come in.
Thank you for getting the ball rolling around the important impacts around the CoFI bill, Lizanne. So about those three customer categories, you said financial customers, retail financial customers, and small enterprise financial customers. By way of clarity, how does this distinction impact any applicable regulatory requirements that would apply, if at all, that is?
Okay, so I think this distinction is really aimed at bringing in this proportional application. So it definitely does have an impact on how the regulatory requirements are set up. And in the most recent version of the bill that we've seen with these definitions, there are also certain of the requirements that apply specifically to retail financial customers and to small enterprise financial customers. So, for example, in the bill, the business conduct chapter, to an extent, where the business principles are, those are really focused at retail and at small enterprise financial customers. And if you think about it, I mean, there are specific risks involved in dealing with those types of customers that you don't necessarily deal with if you're dealing with big corporations that have large legal departments and that understand, and then they are as familiar, if not more, with how the financial sector operates. So it is really aimed at bringing in that proportional application. And you will see it as well when you get the bill. I mean, that is also kind of the way it's been structured, to say that in the application, this applies to retail guys, and by definition, a retail financial customer is then just a natural person that is a financial customer. So it definitely does bring in different nuances. And then, of course, again, in the subordinate legislation as well, we might use those distinctions as well to craft the appropriate requirements that can apply. So I hope that deals with your question.
Well
Thanks,
understood.
Brad.
Thanks, Lizanne.
I see Lizelle's hand is also up.
We haven't got mics open yet. Lizelle, if we can hold your question until the end when we will open up mics for participants, or otherwise, if you're able, if you can pop your question in the chat, we will be opening the mics at the end. So Lizanne, Eugene, happy for you to move forward at this stage.
So I'm just going to very briefly touch on the content of the bill and how it's structured. And I'm going to hand back to Eugene, and then he's going to take you through the transitional arrangements. But essentially how the bill is structured in a flow, I mean, there are a lot of similarities from the previous version. It set out the general business principles that apply, that really aligns to the TCF outcomes. So what many of you might know is, for example, in some of the sectoral laws, we have incorporated the TCF outcomes. For example, in insurance, but in other sectors it is not. So what this will do is it really introduces these outcomes applicable across sectors in a principled manner. Then there are specific requirements around governance and culture, some transformation requirements, including the requirement to have a transformation plan, quite specific requirements regarding representatives and the appointment of representative, requirements around departments of representatives. So there's a chapter on that. Then there are these general principles relating to the providing of financial products and services. And that really goes to the heart of conduct about how products are designed, how they are offered, how they are sold, and how they're consumed by financial customers. Also, very importantly, advertising and disclosure that links again to how products are sold. And then the ongoing obligations on financial institutions, so how they deal with product termination, for example, how complaints management is done, and the servicing standards, so how the ongoing obligations of standards. There are then requirements for the handling of funds, so really custody and trust property, how that is being dealt with. Financial soundness and operational ability. Again, the bill brings in some proportional applications. So, for example, where there are financial soundness requirements in a financial sector law, for example, in insurance, we don't also bring in financial soundness requirements relevant to insurance sector because that's already being dealt with by under the Insurance Act. But for those entities that will be regulated only by the FSCA, we bringing those requirements are set out in the bill there. At a high level, then also some financial management and auditing requirements, and also enabling reporting and public disclosure requirements. And then also what the bill brings, as many of you might be familiar with, the standard making powers that's already set out in the FSR Act. So what the bill does is it expands on those conduct standard making powers, but this is specifically, so the FSR Act requirements, enabling provisions apply to the financial sector regulators, but what is in the CoFI bill is really enabling the FSCA with regards to our standard making powers and our subordinate standard making powers. And that is really just a snapshot of what the bill looks like. And Sam, I see your hand is up, so please come in.
Yeah, thank you so much, Lizanne. And I think this is actually such an important slide, especially as we've been going through our Omni risk return workshops with members and obviously attending the FSCA's workshops, because this really speaks to all the categories in respect of which the regulator is looking for reporting, and maybe just give some further insight into members as to the areas of importance and where the focus is. But particularly around the point on transformation requirements. We know this is an aspect that we do get a lot of questions from our members. Are you able to give us any insight at this stage as to what your expectations will be and how the process around sort of your transformation requirements will work?
I can maybe take that one. Yes, so maybe I'll position firstly how the bill approaches transformation, and then just give some additional context. So basically, there's one section, I think it's a section on transformation in the bill. And basically what it says is that to the extent that a financial institution has a commitment in terms of the BBBE Act, So in other words, the financial sector code, if it's got commitments and not exempted, for example, it needs to develop a transformation plan to show how it will execute on those commitments or obligations. So it's not a case of really creating anything new or enforcing transformation requirements. It's literally almost piggybacking on the BBBE requirements, and then just trying to formalize so that we have a view of how financial institutions aim to comply with their commitments. So that's what the bill does. And I think, I mean, there are empowering provisions, as Lizanne said, so we can, I suppose, further unpack what we want to do in terms of transformation. But at this stage, the focus will be twofold. So one, it will be, as I said, to look at the plans that financial institutions develop, as reflected in the CoFI bill itself. So it's not new requirements we'll be making. We will be supervising that requirement and checking that financial institutions develop and execute on their transformation plans. Then secondly, one thing that is very missing and which makes it difficult to even consider going into a more formalized legal framework for transformation is a lack of data. There's very little data available in terms of transformation. So what we will likely do as a second step to back up what I just said is we will impose some reporting obligations in terms of transformation. So I think that will start even from licensing stage. So if you apply for a license, you need to give insight into transformation issues relating to directors, etc. We will also require that typically from existing financial institutions, but we are still building at this stage basically the transformation metrics, which will inform what type of information we want to request. But I think what you can expect is some form of reporting on your transformation as a financial institution. But I think, yes, Sam, at this stage, that is basically all we're looking at, and nothing further. We have received questions on, okay, but if a requirement is that you must have this plan showing how you will execute on your commitments, what happens if I don't have a plan? So in other words, what will the enforcement measures be? And there were specific questions if that could lead to the, cancellation of a license, for example. Now, I don't think we have formulated views on that, but I mean, just to note, terminating a license is literally an action of last resort. There are many other actions in between. We can issue directives, we can issue penalties, etc. So we will still have to consider what is the most appropriate enforcement action if there are issues with developing and implementing plans. I don't think terminating a license will at all feature at the initial stages in any case. But that's still something we need to unpack. So there's, I think, a lot of concern from industry surrounding this issue. But yes, I think at this stage, all I can say is we are unpacking the issues and we will provide more clarity as we go along. But it's maybe not as intrusive as industry might think it's going to be.
Thanks, Eugene. I think that'll probably be very comforting for our members to hear at this stage. Thanks so much.
Eugene, and I think that segues you nicely into taking back on the next slide and the transitional arrangement. So I'm going to hand back to you.
Thanks for that. So transition deals with licensing, but it's also a bit broader. It also deals with frameworks, etc. But I will first start with the transitioning of licenses. I do think that's probably, as I mentioned previously, the highest immediate impact on financial institutions. And I just thought of something that I probably should have mentioned when I had the licensing discussion. Well, two things. So firstly, the one, it's not a new activity, but it is a new licensing activity that is being brought in and which might be relevant to some of you is, I don't know who of you perform binder functions as you currently know it, as defined in the Short and the Long-Term Insurance Act. But binder activities is not currently a licensed activity, so there's no licensing required in terms of the Long or Short-Term Insurance Act. There is potentially some overlap with the FASE Act, but I mean, it is a bit ambiguous. But going forward, the bind activities will be a very specific licensing activity. So it does reflect in part 2 financial services. We seem to have lost either Lazan or the slideshow. I'm not sure which it is, but I'll continue notwithstanding.
I can
So
share
yes,
your slides for me if you'd like.
I would appreciate that, Sam. I will continue in the interim, but
I'll
when
pop
you're
them
ready,
up, no
please
problem.
flag them. Yes, so first point, binder activities will be a specific licensing activity. And then secondly, what I didn't mention, and we do get questions on this, is exactly how it will work. Do you need multiple licenses if you perform multiple activities? And the answer is no. You will have one license under the Financial Sector Regulation Act. So call it a conduct license for lack of a better term. So you will have one license per financial institution, per legal entity. On that license, you will be authorized for whichever activities you perform. So let's say you provide financial advice, you perform binder functions, and you do administration. You will have one license and you will have all 3 of those activities on your license. So that's sort of the approach that is being proposed. In terms of how will it work, because everyone has got existing licenses under phase, as an example, somehow we need to transition that all to a license under the Financial Sector Regulation Act. We will have to map it to the new activities because, as explained, what we know currently as intermediary services will not continue to exist. It will be broken down into various other activities, and we need to map you to the correct activities and grant you the correct license. So the transitional arrangements in terms of licensing in the CoFI bill makes a distinction between existing licenses and new activities. So existing licenses would include where you have existing license under existing financial sector law. That would be the FASE Act, it would be CISCA, it would be even the Prudential Acts like the Banks Act and the Insurance Act, etc. And what the arrangements say is that you can continue conducting business, so you don't have to stop or apply for a license, etc., until the FSCA has converted your existing license to a new license under the FSCA Act. So the obligation is on us to take your existing license and convert it. Obviously, we can't do that without engaging with financial institutions because we won't know. We license you for intermediary services, as example. We don't know which of the intermediary service activities you might or might not be rendering. We might have a sense, but we don't have the specific information. So what you can expect is that we will reach out to each and every institution to have a discussion on this. Well, it might be a general information request we sent out. It might be a specific information request we sent out. I think we are still unpacking what the best approach might be, but you will be engaged in one form or another to have a discussion on this and to get insight from you in terms of what are the appropriate activities that you should be licensed for. So there will be an ongoing discussion. I think that will take quite a bit of time if we consider the scope of financial institutions we're dealing with. If the insurers went to an almost similar exercise a few years ago when the Insurance Act was introduced, and that took 2 years to complete the whole process, and the PA almost didn't finish it in time. We are talking, tenfold the number of institutions when we look at this process. So I think we are talking about a multi-year process here, and it is not something that will happen quickly. But anyway, I'll pause there and I'll continue on that just now. So that's for existing licenses. We will convert. The responsibility is on us. You don't have to submit anything until we tell you to submit something, and then we'll have discussions with you and convert your license. For new activities, so that's activities that is not currently subject to some form of licensing under financial sector law, like Forex-related services, investment banking, etc. How that will work is they can also continue to conduct the activities, but then there will be a time frame within which they must submit a license application to provide those activities. And we will then consider the license applications, engage with the entities, and eventually grant it. However, again, this won't be a big bang approach. So there's a very broad scope of activities coming in. And we will need to consider how do we prioritize this. So the transitional arrangements provides a lot of flexibility to us. So it does say that we can determine different periods for submitting licenses. So in other words, in practice, what this could mean is that we can say we view alternative investment funds as the highest priority. So in the second half of 2026, we are opening up license applications for alternative investment funds. We view credit as the second highest priority. In the beginning of 2027, we are opening up license applications for credit activity. So it will be a staggered approach, in other words. If you as an intermediary are interested, for example, in playing in the Forex space, you will therefore have to monitor when the license applications for Forex opens up, and you need to ensure that you submit a request to authorize you for that specific activity. Yes, I hope that's clear. Brad, sorry, you had a hand up. I just wanted to finish that thought. Did you want to come in?
Thanks, Eugene. Yeah, with respect to this transition processes with regard to the licenses, I know your slide states that the regulator is required to publish its approach, reflecting how it will give effect to this arrangement. But I mean, at this stage, are there any timelines or guidance that the regulator can provide? I know you did refer to a multi-year timeframe, so just a bit of clarity requested if possible.
All right. The short answer is no. That's the simple answer. And maybe I will ask that we pen this question when we get. I'm not sure if it's the next slide. I'll have a look just now. But when we get to the FSCA implementation discussion, because there I touch on what we are currently doing in preparing for this, and I do touch on licensing as well. But the short answer is no. We don't have timelines at this stage. It is something we are considering. We are busy looking at the prioritization of activities, as I've mentioned. And the key thing for us at this stage is to formulate what you just mentioned, just to give clarity, the plan that will give effect to those transitions. So as you mentioned, Brad, the bill also states that we must, I think within 6 months after the effective date of the licensing transitional arrangements, publish a plan that will in detail explain what our entire approach is going to be. So, I mean, that is the document that everyone in industry should wait for and look out for, because that will explain how everything will work. I'm giving a high-level feedback, but that is really the document that will go into granular detail on how we will deal with these issues. But I'll talk to that a bit more when you get to the FSCA preparation, preparatory work. Okay. Then, so that's on licensing. I hope that's relatively clear. Then I want to touch on legislation as well, because there is this view often that I hear that on day one, CoFI will come in and it will be this big bang approach. And that is definitely not the case. And just to contextualize, so we sit currently with various sectoral laws, and as Lizanne said, they will be repealed. So the FASE Act will be repealed, CISCA will be repealed, the Long Short-Term Insurance Act will be repealed, etc. Each of those laws sit with a massive body of subordinate legislation. So you know the FASE world very well. We're sitting with general codes of conduct, fit and proper requirements through a determination, specific codes of conduct, and various other types of notices, etc. What we have to do is we have to migrate that to the CoFI bill in some form or another, because otherwise we just perpetuate this fragmented approach. But what the CoFI bill says is that anything done under existing law, even if the law is going to be repealed, will remain in effect until the FSCA repeals it. So in other words, on day one, when CoFI comes in, it doesn't mean that the general code of conduct will disappear. It will still be law. And that applies to all other subordinate legislation. So what we are doing, and again, I'll talk to that when we get to the CoFI bill implementation, and Lizanne will talk to the framework issues. But just on a high level, we have to plan for how we take all of the existing frameworks and transition it to the CoFI bill. So this is a very important savings provision, because if everything had to disappear on day one, I think everything would be in chaos for us, for industry, etc. So maybe the message here is, don't be concerned that there will be major changes immediately. There won't be. We will approach this whole process very responsibly and very carefully to ensure we transition everything in a very structured and very clear and transparent manner. And that goes to the licensing process, to the frameworks process, etc., etc. So that's maybe the one message I really want to emphasize here, and hopefully alleviating some of the concerns. In addition, one additional transitional arrangement is that the Act says that the minister can bring various provisions, in my own words, can bring provisions into effect at different dates. So, in other words, even though the bill is made, it doesn't mean it is effective immediately. We can ask the minister even to say, let's postpone the licensing requirements. Let's make that effective at a later date until we are ready. So there's my message is, there's a lot of flexibility built into the whole process to enable us to give effect to a very fair and transparent and responsible transition. Okay, thank you. That is on the CoFI bill itself. I think moving on to, oh no, one important thing which is really very relevant to you, I think, notable impacts that I just want to highlight, and that relates to institutional form and sole proprietors, and then also representatives. So the activity schedule, which I explained, contains a column dealing with the required institutional form of a financial institution. So per activity, it sets out what institutional form is allowable or not allowable. If you are authorized for multiple activities, obviously you will just comply with the most onerous requirements. So I think the key change, so in many of these, I think most institutional forms are allowed. So, for example, just using a few examples, for the sales and execution activity, there is no limitation. And what that means is any institutional form is allowed. And for example, a sole proprietor can obtain a license for that activity. The same applies with financial advice. The two, oh no, sorry, it's more than two actually. Just checking administration. I think that one might have changed, but let's pause that for now. But the clear outliers is discretionary investment management, and that is your category. If you had to equate it to existing activity, that is your category 2 FSPs. They will not be allowed to be licensed as a sole proprietor. So you have to be a company if you want to be a discretionary investment manager. The same applies with binder functions. So if you perform any of the binder functions, the 5 that there are, you will have to be a company. And then lastly, operating a linked investment platform, that's your LISPs, your current category 3 FSPs, they will also have to be a company. So sole proprietors are being phased out, but in the context of very specific activities. And my understanding is that was on a risk-based approach. So there is discomfort allowing a sole prop to act as a discretionary investment management company, as an example. I see that for general administration, I just want to check something. Yes. So any institutional form is acceptable, except the sole proprietor and subject to requirements. So I need to double check where that landed up. I know it was subject to various discussions, but that seems to be where it ended up. But it might change. So I'm not going to go into detail on that one, and please don't take that necessarily as the final position. And then the last one is on services related to crypto assets. Once again, viewed as high risk activity, and the intention was not to allow institutional form of sole proprietor for that activity. So this might have an impact on some of you. Again, if if you are, for example, a Category 2 FSP in a sole prop form at this stage, there will be transitional arrangements. So you will be allowed to continue as such for a defined period, but at some stage there will be expectation that you transition that to a company form. Yes, I think that is all on this. We can move on. So that's one important impact to note. The other impact relates to the institutional form of representative, and which includes juristic representative. So similar to what I've just discussed, there is a representative activity schedule in CoFI, Schedule 1 of the CoFI Bill, and that sets out for which activities you can act as a representative, meaning you don't have to have your own license. You can be a representative of a licensed financial institution. But that is also linked to a very specifically identified institutional form. So for most of the the representative activities, any institutional form is allowed, meaning very specifically to juristic representatives. You can be a juristic representative on most of the activities. However, there are two exceptions, and that is for discretionary investment management sub-activity again, and then managing alternative investment funds. For those, we are not allowing juristic representatives. So we don't want the practice that I'm saying we don't want, but it's actually Treasury, the practice where a licensed financial institutions adds a whole number of companies on its license as juristic reps for discretionary investment management is not being allowed anymore. What that means is that you have to go and obtain your own license and go through the licensing process, etc., if you want to provide discretionary investment management services as a company. Individuals will still be allowed. So me as Eugene, I can be a representative on a licensed financial institution for this activity, but I can't establish a company and put that on the license of the FSP. I need to obtain my own license. So this is quite a substantial shift, but only impacts the discretionary investment management space and the alternative investment space. Sam, have you got a question on this?
I do indeed. Bearing in mind we have a number of members who are discretionary investment managers. And what really is the rationale behind this? And again, to your point around the licensing transition, what sort of grace period will be provided to allow those members who have these structures in place to transition out of it? So I think the two elements, the rationale behind it and then the transition.
All right. As I've mentioned, so if you talk about this, for example, it's really a risk-based approach, because what happened in this space, and it's not a lot of I mean, we did look at this in a bit more depth. It's not a lot of financial institutions that have a significant number of juristic reps on their Cat 2 license, for example. There were a few outliers, so one or two institutions that have a massive number of juristic reps. But the problem here is that the institutions, it's a very easy way, let me put it this way, it's a very easy way to sort of get access to the this financial activity, sector, if I can put it that way. It's easy access to the discretionary investment sector by just being put on a license as a juristic rep instead of going through your own licensing process. So, as you know, typically a licensing process is critically important because it looks at your governance structures, your directors, what processes you have in place, do you have the necessary capital, etc. And it's almost a screening exercise to consider whether this institution should be let into the system. So a preemptive measure to avoid risk coming into the system. However, with this juristic rep approach, it's very easy to just get into the system, as I've just mentioned. So the concerns, especially in this space where this is a sophisticated activity, and which Treasury is of the view, it should be, if you want to play in this space as a company, you should be subject to a licensing process, as everyone are, to avoid unnecessary risk or unchecked risk coming into the system. So that was basically the rationale here, is to say, discretionary investment management and managing alternative investment funds is a critical and sophisticated activity. Let's not just let anyone into the system extremely easily. Let's do it proper through a proper licensing process and a screening process. That was the rationale, essentially. You had the last question was on transitional arrangements. I don't think I can give timelines at this stage. I remember we did communicate to Treasury that the bill doesn't sufficiently address the transitional arrangements for these two things. So Treasury agreed that they will build in transitional arrangements. I haven't seen what it looks like, so I don't know what they are proposing in terms of time periods, etc., and can't advise at this stage. But I'm sure it will be reasonable, something like 2 years as an example, I think.
Thank you. I appreciate that feedback.
Okay. All right, just in the interest of time, I'm going to move a bit more quickly on this, because I think the important discussion is the next one on the subordinate framework, which Lizanne will be dealing with. But just to give you a sense of what discussions are currently happening within the FSCA in preparation for the CoFI bill. So the one important discussion is what I already touched on, is how do we prepare a subordinate legislative framework under the CoFI bill. And I'm not going to touch on that. I'm going to leave it to Lizanne, but it's a very critical component of this whole process, and it is one of the areas that we have made some progress on. But Lizanne will give you a bit more insight on that. The second component, which I already touched on as well, is the transitioning of existing licenses. So as I've mentioned, that will be a multi-year project. It's really a extremely difficult exercise. There are some dependencies that exist. So, for example, we are busy developing some of the frameworks that will underpin the bill already, which Lizanne will touch on, but some of those frameworks has an impact on licensing. So, for example, fit and proper requirements. Those are things that we need to assess at a licensing stage already. And because the framework is not yet ready, it makes it difficult to consider how we will approach the licensing process. And then the other critical consideration is the mapping of the existing activities to the new activities, one, and two, all of the new activities coming into our jurisdiction and how we then prioritize what we look at first. So those are sort of the critical issues that we are focusing on, and how we are going to provide for staggered implementation and prioritization around that activities. We've already initiated the discussions. The prioritization process is underway, and it's critical that we fast track that, because, as I've mentioned, we need to publish something in due course that will show how that will occur. But at this stage, as I've mentioned to Brad, we don't have timelines that we can discuss. Where we are at this stage is we are considering how to prioritize what we do first. Then there's also a massive supervisory impact for us. We are busy already looking at, not linked to CoFI, actually, we started pre-CoFI, is we are revisiting our risk model. So our key risk indicators, etc. And that links into the new RegTech system we are developing, which is called our IRS, and it needs to inform that system. So it's highlighting our approach to risk-based supervision, essentially, and what are the key risk indicators. That, in turn, links into the risk returns process. So Sam mentioned the risk return. So a lot of the sort of indicators that you see are on the risk returns comes directly from the risk model that we are busy defining. So everything is interlinked. And then the question is, okay, but how does that link in to how the CoFI bill is structured? So as Sam said, there's already linkages that you will clearly see to some of the requirements, but we need to expand on that and ensure there's full alignment between our risk approach and the conduct of the CoFI bill substantial requirements, and vice versa. Whatever the CoFI bill is bringing in, we need to ensure that is reflected in our risk model and risk return. So those are things that we're busy considering. The other thing is, which I didn't specifically mention here, but there's obviously a massive capacity impact on us. If we're now taking on a broad scope of new activities, How do we create capacity, ensure that we can license those activities, that we can supervise those activities, and is our supervisory structure appropriately structured to actually supervise these activities? So it might result in structural changes as well. So all of those discussions are busy taking place within the FSCA at this stage. And then we are also considering, as part of our internal process, what are the key strategic impacts flowing from CoFI? We've already identified some, but the formal process that we have initiated at the highest level, so our ExCo is involved in this, is trying to identify all the key strategic impacts flowing from CoFI, and then formulate appropriate responses and implementation plans to deal with those key strategic impacts. So, yeah, it's a lot happening. What our process entails is we've established a steering committee comprising, as I said, ExCo members and senior management within the FSCA. We are at a conceptualization stage currently, where we are conceptualizing the plan, and then I think the implementation will only start probably during the course of next year, although some of the things are already being implemented, such as the framework discussion, which Lizanne will be taking us through just now. My point here is that, you know, there's a lot of work happening behind the scenes that you will not be aware of. In due course, I think all of this will result in some form of roadmap that we develop and that we will typically publish as well, I think, to give you a sense of what all the moving parts are and what you can expect from an implementation perspective. So, you know, the request at this stage is be patient. There's a lot happening. We are working on it. You won't be aware of it, but we are working on it, and appropriate communication will, you know, follow in due course as and when we have made sufficient enough progress on all of these issues. Okay, if there are no questions on this, I'm going to hand over to Lizanne to talk about the framework readiness. Thanks. Is Lizanne still with us?
Can you hear me? Hello?
Yes, we've got you.
Yeah, yes.
Okay, fantastic. Okay, so if I do at any point break up, just tell me. I can switch off my camera so that you can at least see the screen and you'll hear my voice. But basically, the first part of our discussion today was really focused on the CoFI bill itself, which is primary legislation, and how that is being changed. As Eugene mentioned, this is National Treasury. As the policymakers, it sits within their mandate. We are offering technical support, and it obviously impacts us greatly. But the development and the parliamentary process and everything that is involved in that is really being driven by National Treasury. You know, but what we have done, and Eugene has mentioned, the approach we've taken is we're already quite advanced at looking at how this impacts the subordinate legislation, the conduct standards, the PPRs in the insurance space, the General Code of Conduct, all the codes of conduct under the FASE Act. So how is all of this going to be coming together? Because we are bringing together the primary law is now being consolidated to provide for this market conduct framework, but what happens to what is under it? So we've set out the approach, and I know that Eugene has frequently, and you might have heard him speak at previous events, explained to what our approach is. Going to talk you through it and then maybe just give you a sense of the prioritization and what it is that we're focusing on. But we have we have developed the high-level design of the framework. So how it's going to look in future. We considered various other jurisdictions, other approaches by Twin Peaks jurisdictions and how that was approached. We looked at what is existing there. We did an exercise on that. And I'm going to give you a sense of the high-level framework just now. And then what we did is we identified key conduct themes that apply across sectors and that we would need to develop these standards for. So what we're going to do is we're going to take what's existing out there and pull those into themed standards. The themed standards are also going to be following a principled approach, but really under that, if there are specific requirements applicable to certain sectors, that's currently requirements that it's appropriate, that is in practice and that we want to keep, those might still be brought in and might still be made applicable to certain sectors. But we're going to have these themed frameworks as part of the subordinate legislation that's going to be dealt with it. And that work is already quite well advanced. We've set up industry consultation forums, and there's active participation in it. And I'm going to get to that in what we're doing that in the next slide. And then the third part is really transitioning what is in this existing sectoral laws into these themed frameworks. So pulling that out, and that will then ultimately be repealed. So one day in future, you are not going to have loose standing policyholder protection rules anymore. You're not going to have a general code of conduct for FSPs anymore. And instead, these are going to be transitioned into these existing themed frameworks. It's a multi-year project. It's an incredibly big part of what we're doing and focusing on, and it's really, really requires a lot of thinking. And as Eugene mentioned, the important part is this will also be staggered. So you're not going to wake up one morning, read in your newspaper that the CoFI bill has been signed by the president and everything suddenly poof disappears. It's going to be staggered. It's going to be structured. We're taking a responsible approach to it. And we will be ongoingly communicating with the industry in this regard. So let me just move to the next slide. So on the next slide, this really gives you a visual sense of what the new subordinate framework is looking at. It's structured according to specific themes, as I said. So there's the licensing matters, obviously taking priority because that would be the starting point. Then there are governance, key persons, control functions, and transformation is a specific theme, and that is set out. And you will see on the screen there are certain of the blocks that are marked with a capital H in red. Those are high priority projects for us, and I will speak to those as soon as we get to that. Then there's also the internal controls and operational ability requirements. That goes to specific requirements. There's the business conduct part of it. So as I said, the general principles are set out in the CoFI bill itself, but under that, there will, for example, be a theme of product development and product governance. It really goes to the design of products, the performance and the overview, advertising, advice and distribution, ongoing obligations and remuneration and conflict of interest. And then we've got a theme for technical specific activities. So that would typically be very niche kind of activities that require specific requirements, like in the CIS space. There's quite a lot of them that fit in there, and for example, cell captives in the insurance space. That would fit under the technical requirements. The financial soundness and handling of fund, I mentioned those and how they fit into the bill. So this would be what is existing in legislation, and it might be augmented by additional requirements. For example, if I'm just thinking on the theme of advice and distribution, we often get the question, but what happened to the remaining RDR proposals? These are all going to be considered as part of the transition of the subordinate legislation. So there might be new things, there will be existing things, and all of this is going to be morphed into that. So we've done the design, we've done with the first phase, we're really in the thick of things with the second phase, and that is developing the theme frameworks. So those little boxes that I showed you, this is now just a different way of projecting it to show you in a kind of a table form, what are the priority projects and why. Firstly, governance and culture. We've been working on that for a number of years. Recently, you would have known that the King 5 has been published. We've incorporated that as well, and we're hoping that this joint standard that we're developing with the PA will be consulted on in 2026. We've got the fit and proper requirement. This has gotten the highest priority because of the licensing implications. And as Eugene said, fitness and propriety is something that is considered at licensing stage. It's obviously an ongoing obligation, but that is really, it's important that when the licensing provisions come into effect, we have those requirements. So that's a priority. The same with risk management, internal controls and control functions. High priority because of the licensing implications, but also it's going to have systems implications. So we've heard that industry, we understand and appreciate system developments takes long, it's multi-year projects. So that's again why we're prioritizing that. Eugene's touched a lot on the licensing requirements, so I'm not going to go touch on that again. And then we get to theme frameworks like complaints management. So that is then considered a medium priority. I think we've got quite a well-established compliance management framework already in terms of the insurance requirements and in terms of the phase framework, but it's really, we're going to use the established framework and just build on that. So the intention is for us to do that. Advertising and disclosure, again, to bring that in specifically with taking into account the new activities that's being introduced, the new licensing activities that we did not previously have a mandate on, we did not regulate it before. And then the same regarding conflict of interest and remuneration. And then there are other, some of the other theme frameworks there, again, outsourcing. I think outsourcing is very relevant because of the risk that outsourcing can introduce. We appreciate the fact that it can create efficiencies, but also it can introduce risk to your business. So we are at this stage still discussing with the PA potentially having it as a joint standard. You will know, those of you who play in the insurance space, there's a joint standard on outsourcing in the insurance space. But the question is now, would it be appropriate to have a cross-sectoral one? And we're having these discussions because outsourcing really has both prudential and conduct impacts. I think and I should have mentioned it maybe under the governance and culture requirements, we often get the question saying, yes, but you're doing something with the PA, you're going to develop a joint standard with the PA, so will that be applicable to entities that are only regulated by the FSCA? Yes, but what will then happen is the FSCA will be regulating that. So it might be a joint instrument, but the regulation of it for entities that are only regulated by and licensed by the FSCA will sit with the FSCA. So, and again, the requirements might be, will definitely be proportionate, but we're going to also look at how we can bring it in. So typically you would start out with principles that apply across sectoral, across all the entities. And then if there are, for example, specific requirements that we'd want to make applicable around, if I use a silly example, having a head of risk, if we were to, for example, say a financial institution must have a head of risk, that would not be appropriate across the sector. So those would then be nuanced to apply only to the specific entities, maybe the bigger entities, the bigger corporates, where that is appropriate. So do look out for that as well. With a consultation on the start, data management, important, as Eugene also mentioned, lack of data is still an issue. It's still something that remains very important to us. But we do think that the principles are already there, so we might progress that quite quickly. Cyber risk and resilience. There is an existing joint standard on cyber risk and resilience that came into effect this year. I think it was made last year, came into effect this year. I think what we also said is, but it doesn't apply across all FSPs, for example. I know it only applies to investment management, FSPs and the like. So, and what we said when we made that joint standard is we said, well, we're going to consider, because a lot of the principles, again, would be appropriate and good practice. So just because it's not law and you're not going to be fined if you don't have it, doesn't mean that it wouldn't be appropriate for you to incorporate that as part of your risk management and your cyber risk management requirements. So we are considering having a kind of a toned down version that can be applicable to smaller entities to still bring in the necessary protections, but to have it appropriate and not as onerous as the joint standard is. Product development has implications, obviously, for the new activities that we're going to be supervising, but that will be over the longer term that we're doing that audit and audit requirements. I think the reason why that is a low priority is because, to a large extent, the requirements that we deem appropriate will be set out in the CoFI bill itself. So we might augment that with nuanced changes that might be appropriate to certain entities, but for now, that is more on the back burner. And then custody. The reason why custody is low priority at this stage is not because we don't think it's appropriate, but I think Eugene has said this often when he's presented on our regulation plan, is that we don't want to change just for the sake of changing. So if we know something is going to be impacted by the Financial Markets Act review, we're not going to prioritize it and make a joint standard in future. It has to change again because we don't want to introduce repetitive change. We'd rather take a structured approach to it. So the custody and custody of funds nominees, the reason why that is a low priority is because of the Financial Markets Act implication and that National Treasury is working on. So there's just the last point on the themed frameworks and the second phase. As I mentioned, we've established industry reference groups that are experts on these specific themes. It's done under the auspices of the Market Conduct Committee. And I think the purpose of this is really to discuss fundamental policy issues. So it's not groups that come together and talk about drafting. It's about the fundamental implications of these things, and that we really it's incredibly important that we get the perspectives of all the industry players as these frameworks develop. We are consulting, we've started consulting on the two high priority frameworks that I mentioned, the fit and proper theme framework and the risk management and internal controls framework. And also then I think the next step for us would be in the new year, we're likely going to set up a workshop to discuss the compliance management theme framework. And then the consultation on the remaining ones that I've just listed in that table below is going to go on throughout 2026. And then the public consultation will start when we're done with these industry reference group consultations. So this is really more of a informal kind of technical expert consultation. The public consultation will still follow. So all of these frameworks will still be published for public consultation. It will follow the typical process, the statutory process that we follow when we make these standards. So it will also still be published in future. Then just the last couple of thoughts from me and concluding remarks, and I'm going to hand back and maybe to Sam and Brad. If you ask me what is important about why must the industry be aware of the CoFI book, this introduces probably the most significant change to the legislative framework in the financial sector that we will experience in our careers. This is the biggest change, and it is incredibly important that we have the involvement from everyone in the sector, from those who are impacted by this change. It should not be underestimated. And as humans, we tend to, when change is hard and change is intimidating, so we tend to say, no, well, I'll worry about that later. I'll worry about it after December. Do not underestimate the impact of this change. We really, really, really need your input. So make use of forums like the FIA and the industry associations for active engagement. If something is published, please do consider it, consume it, and comment on it. I think if you ask me what financial institutions must do now, they should assess the implications. Start thinking about the activities you perform as an entity that operates in the financial sector, because the first and a very important part of it, and Eugene spoke quite a lot about it today, is the licensing implications. So start thinking about that. Start thinking about, what are the activities performed? How is your business structured? Really look inside how your organization is set up. And start thinking about, your approach to compliance, how is your governance structure of the organization set up, of your company set up? Because this is going to have implications over the medium to longer term. So I'm saying start thinking about it now, because we do appreciate once you can see the bill, it will add that benefit of starting to understand all these things that we are discussing at a conceptual level now. It is easier to consume something once you can read it, see it. And that is expected to come quite shortly. And then, just again, a very, very strong call. Please do participate. Participate in your industry association, participate in the consultation from the industry, dial into webinars, provide your input as frequently and as often as, and please don't make drafting suggestions, because we do have people who check it. We need to understand the fundamental implication of what it is that we're putting out there. So it's really just a call for, let's please get everyone involved. This is going to change. It's unavoidable, but you can sit back and it can happen to you, or you can be part of creating it. Thanks, Sam.
Thank you so much, Lizanne and Eugene. I think it's been an incredibly informative session. We are very short on time, but I think we've probably got a moment to allow some hands up for one or two questions. Tulani, if you can confirm to me if you're able to open the mics, and I see our CEO has her hand up to obviously ask the question she wanted to ask earlier. If over to you, Lizelle, to ask your question.
Yeah, thanks very much, Lizelle, to you and Eugene for making time for sharing some of these insights with our members. And I really think what has been most assuring for us is this sensationalism around CoFI and how you have just practically sort of suppressed some of that, and that it's a very organized and it's a very structured approach. And I think for that we truly want to say thank you. Just three things from my side. The first was around the dual regulation. Eugene, you had mentioned that the FIA should look to submit something through to yourselves around that. I mean, particularly that healthcare brokers, being small to medium-sized enterprises, dual regulation on conduct is really unnecessary and burdensome. And the FIA has been very consistent in sharing its views on that dual regulation because of the increased cost of compliance with no real benefit to clients. I think we would certainly take you up on that opportunity to share further input that the FIA has on that. The second is on the transformation plans. I just wanted to assure yourself and Lizanne that what the FIA has done, and it has also been CPD accredited, is we developed transformation guidelines for our members, but made it very practical even for small businesses, so that all businesses can make a contribution, irrespective of how big or how small, what you can do to make a practical impact in anticipation of CoFI. So that was done about 2 years ago. So those transformation guidelines remain available to our members. So also maybe just to remind our members that if they need access to that, they can reach out to us. And then my last point was actually the question. I don't know, Eugene, if it was to yourself or Lizanne, around the customer segmentation, particularly concerning for us was the engagement we had with the Minister of Small Business and Development 2 weeks ago, relating specifically to the high cost of advice through compliance and how that starts to impact sort of that retail to middle segment customer, because it just becomes too expensive to service that particular customer segment. And just some understanding from you around compliance when you say it is outcomes based, just to really bear that in mind, that I think there's such an importance around servicing that layer of clients. And if it becomes too burdensome, what we don't want is advisors then to say, well, actually, it's going to become too complicated to service this particular market. Just maybe some assurance from you that you do take that into consideration. Thank you.
Right. Sam, can we jump in?
Please do.
Maybe
Absolutely.
respond to that. Lizanne, I don't know. I hope you don't mind. I've got some thoughts and you can just augment as necessary. On the first two, just quickly. So the dual regulation issue, I mean, that what you raised, Lizelle, is more a policy issue as opposed to operational efficiency issue, right? So it's a broader policy question on whether there should be dual regulation, and the solution there would be a policy shift. So which is not an easy thing. So I was referring to more, if there are operational inefficiencies that we can deal with through an agreement with the CMS, we can look at that and support that. We can't really, from our perspective in any case, change the policy approach which establishes this dual regulatory environment. It doesn't mean you can't prepare something, but the point is that Treasury will have to be involved in that discussion, being the policymaker in this instance. So maybe just that one point. But I mean, we can have an offline to discuss how we approach this and take it forward. On transformation, just one question. The guidelines you referred to, is that publicly available or not? If not, can you perhaps share that with us? I think that would be very interesting to us as well as we prepare for taking on this topic of transformation going forward. And then lastly, on customer segmentation. So I mean, it's a very good point that you raised. And the critical thing here, or the two opposing factors, I suppose, is one, you don't want to overburden and increase costs, but on the other hand, you want sufficient protection for these types of customers, depending on how you define it. I mean, if you just consider COVID and the business interruption issues that arose, the fact that they were excluded from the PPR, which is only applicable to personal lines, not commercial lines, created an issue, and emphasized that there has to be some level of protection for small businesses. So I suppose the discussion that one has to have is, how do you balance out these sort of two competing factors? A critical thing, I think, would be, and I mean, we didn't unpack the approach in detail, but what we didn't mention, which I can perhaps mention, is that the bill doesn't really define a small business enterprise. It provides the FSCA with the discretion or obligation to define what it is for purposes of the bill, which means that we need to go back and consider, where do you draw the line in terms of the level of protection for which types of businesses? And what would be important is, when we make proposals on who should actually be included as a small business enterprise, to extend the level of protection, which links into the compliance cost issue. I think we need engagement on that and need to get your insights as well. So that's probably the important discussion that we have to have when we get to that stage. Yes, Lizanne, I don't know if you want to augment anything, but that's just a few views on my side.
Thanks, Jean. I think you've covered it.
Thank you so much. And I note that there are two hands up, but we are essentially out of time. If there are any pressing questions, please do send them through to Brad or myself, and we will look to try and find suitable responses from Eugene and Lizanne, if they'll accommodate us. But I think, just as we finished off today, and I think Lizanne did touch on most of them, but there's a couple of key points that I think we really want our members to keep front of mind, and that is to keep assessing your readiness against the licensing and governance and operational and compliance requirements, and just to make sure that you're as ready as you can be for these transitions as they take place. Participate in the industry consultations when they come available, engage with us as the FIA, and help shape implementation that both serves the sector and the policy objectives. On behalf of the FIA, I really want to extend my sincere thanks to Eugene and Lizanne for your very comprehensive and detailed and invaluable presentation today. The work being undertaken by the FSCA's team is complex, it's technically rigorous, and really important to the future of our industry. And we appreciate your transparency in sharing not only this framework with us, but also your readiness plans and timelines. And we see our engagements with you as absolutely fundamental to everything that we do. So we are truly grateful. And for the members asking, yes, indeed, the presentation will be shared. The recording will be made available on our YouTube channel. It is CPD accredited for 1.5 hours of CPD. And we really want to confirm that we remain committed to facilitating the dialogue between the industry and the regulator as the CoFI bill journey continues. Thank you so much again to everyone for attending, and more particularly to Lizanne and Eugene. We truly are grateful. Thank you so much.